All right. So we have covered FHA insured 2 to 4 unit properties, the underwriting guidelines for buying 2 to 4 units with FHA. We've covered buying 2 to 4 units with a Fannie Mae conventional. And today we're going to talk about buying 2 to 4 units with Freddie Mac conventional underwriting guidelines. Now, why would you even buy 2 to 4 units? Like maybe I don't want to be a landlord. Well, this is actually pretty popular with the kids today. They call it house hacking. And this is a really, really smart strategy before house hacking was even a thing. And house hacking, if you're just running into it, if you're not familiar with it, is basically buying a house. A lot of times it's renting out rooms using Airbnb. Basically, it's renting out the property to get other people to pay for your rent, and that's exactly the opportunity that we have here with 2 to 4 units. You can buy a duplex. 3 unit property, 4 unit property, and this allows you to live in one unit while renting out the other units for additional income. This is really, really smart because if you can get your rents covered, you can almost live at that property for free. Now, that's not how it's going to work out. In most cases, you're not going to be able to cash flow your property, but there's some really good opportunities to knock your payment way, way down, lower than you would if you were to just buy a single family property and live in it with your family on your own. So these are exciting programs, and if you have an opportunity to look at buying units, this is a really smart way to buy in a market where there's not a lot of inventory and interest rates are a little bit higher than they've been in the past. So this is a really good way to drive those costs down. So the reason why I'm breaking it down for FHA, VA, not USDA, doesn't allow units, FHA, VA, Fannie Mae, and Freddie Mac, is because all of these programs are a little bit different. So if you go and you talk to a loan officer and they say, oh, you don't qualify to buy this duplex, but they're only trying to get you approved using like Fannie Mae guidelines, there may be a nuance there that Fannie Mae doesn't allow it and Freddie Mac does, or Fannie and Freddie, neither of them allow it, but FHA does. So that's why we're kind of going through this. And so the big difference is there's different loan types that you can use. The loan to value or the down payment requirements are different for each of the programs. The credit scores tend to be different between conventional and government. Whether you can have a non-occupant co-borrower, that's somebody who does not live in the house, but they're going on the application to help you qualify for the loan. Some programs allow it, some programs don't. There are different reserve requirements, how much money you have to have in the bank after you get approved for the loan, after you put your down payment, your closing costs, and all that. How many months worth of payments you have to have. That's usually called reserves. ADU units, additional or accessory dwelling units. We also call it additional dwelling units. But accessory dwelling units are basically detached. So if you have a duplex, it's usually you share one wall. There's one side that you live in, there's one side that you rent out, and there's a wall in between them. That's a normal duplex. Threeplex, three houses connected. An accessory dwelling unit is usually a detached unit. Like think of a detached garage, but it's actually converted into a little house, has a little kitchen in it and things like that. So does that count? Can you buy a duplex with an accessory dwelling unit on it? Some programs allow it, some programs don't. And then finally, the most important thing is, can you use the rents from the units that you're not living in order to qualify? We know you can use the rents to help you pay the mortgage, but can you use the rents to help you qualify for the loan? Do the rents from the other units count as income before you even own the property? And the answer is yes, and we're going to get into what that looks like. So With the Freddie Mac conventional underwriting guidelines, the loan programs that you can use is you can use a fixed rate mortgage to buy 2 to 4 unit property. You can use an adjustable rate as long as the fixed part of it is greater than 5 years. Now, there are very few adjustable rate mortgages that just start adjusting right away. For instance, if you get a home equity line of credit, like a HELOC, if you're already a homeowner, those are typically adjustable and those adjust every single month. But on usually what you're looking at, it's called a hybrid ARM, and it's usually fixed for 3 years. They're called 3-1, 5-1, 7-1, or 10-1 ARMs. And that means that it's fixed for 3 years and then it adjusts every year. It's fixed 5 years, then it adjusts every year, 7 years, 10 years, and then it adjusts every year after that. So fixed rate or adjustable rate mortgages, as long as it's fixed for 5 years, you can use it to buy a 2 to 4 unit property. And the reason why people would do that, 5 years is probably a safe gamble, especially in this market. Rates are likely to go down before the next 5 years. But you want to be careful with those things, because if the market's not any better and home values have gone down or rates have gone up, and then this thing starts adjusting, you could really run into some challenges. But 5 years is pretty safe. Most people don't keep their loan for 5 years unless you bought a couple of years ago and you got an interest rate that's closer to 3% than what it is today. You have to it can be owner occupied. We're going to talk about owner occupied units today. That means you're going to live in one of the units. Of the 2 to 4 units, you're living in one of them. You can use the Home Possible, which is the affordable lending program with Freddie Mac. And then investments. You can use Freddie Mac for investment units that you're not living in one side of it, but we're not covering that today. We're only covering house hacking strategies, where you buy the house, you buy the units, you live in one unit, and you let the rents from the other units help not only qualify for the loan, but helps you pay your mortgage every month. So, standard loan to value. So I present this in both ways. Loan to value is typically how it's presented to a loan officer. Loan officer is told, like the underwriting guidelines usually say, 2 units, maximum 85% loan to value. 3 to 4 units, maximum loan to value is 80%. And then your minimum borrower contribution. So if you're doing if you're doing greater than 80% loan to value, which we'll translate here in a second, which is basically less than 20% down. If you're putting less than 20% down, you have to have at least 3% of the purchase price of your own funds. So it has to come from your checking account, your savings account, some sort of acceptable reserves account. Now, we translate that also into down payment. So 15% down payment if you're buying 2 units using Freddie Mac, and that's with standard Freddie Mac or with Home Possible with the affordable lending. That's 15% down, or 3 to 4 units is 20% down, and then 3% if you have less than 20% down. So loan to value and then down payment, they're the same calculation. They're just stated in a different way. I like to show it to you both ways. So whatever way your head works, you can wrap your head around. 20% loan, 80% loan to value is 20% down. 85% loan to value, 15% down. Now, the minimum credit score. So the automated underwriting system is going to determine what the minimum credit scores are. Generally, you're not going to go below a 620. That's standard with both Fannie Mae and Freddie Mac Conventional. You don't really see anything getting approved under a 620. FHA, you can go below a 620. You can go down to about a 550. I think about a 580 to have the minimum down payment. So that's one issue. If your credit score is around 620, also with conventional, even though they say the minimum credit score is 620, It's highly unlikely that you're going to get an approval at a 620 if you have like a high debt to income ratio. That's really on the low end. Most conventional programs aren't going to like 2 to 4 units under like a 680 credit score. So that's one of the reasons, again, why I break this down. If somebody's looking at conventional and they're like, well, you can put 15% down, but your credit score is not high enough. Well, with FHA, you can put 3.5% down and your credit score can go down to like 580. So again, there's options here. That's why I'm breaking these down and explaining each one to you. Non-occupant co-borrower. Can you have somebody? So it's a co-borrower who helps you with the application. This is not gift funds to help with down payment or closing costs. This is somebody who's going to be on the application. They're going to use their social security number, their income, and their assets are going to be added to yours to help you qualify for the loan. Now, that is a loan. It is allowed for a standard Freddie Mac loan. It is not allowed with Home Possible. However, Fannie Mae's affordable lending program called Home Ready does allow you to use the Home Ready, the affordable housing program for a 2 to 4 unit property. So again, there's those subtle nuances, right? Those subtle differences. It is allowed for standard Freddie Mac conventional underwriting guidelines. It is allowed for standard conventional underwriting guidelines for Fannie Mae. The affordable housing product Home Possible, not allowed with Freddie Mac. Home Ready, affordable housing with Fannie Mae, it is allowed. So you can see why we're breaking this down. I don't ever want you to be in a position where you're told no because there's an inexperienced or a lazy loan officer that doesn't check both Fannie Mae and Freddie Mac conventional guidelines and also understands the guidelines for FHA so that you're being presented with all of your potential options. They're not just looking at the one program that they know and then saying no if you don't fit those guidelines, because they're all different. Reserve requirements. So what reserves are how many months, they call it PITI. It's principal, interest, taxes, and insurance. So it's your total mortgage payment. How much of your total mortgage payment do you have left in the bank after you pay your closing costs and your down payment? So the automated underwriting system is going to determine the reserve requirements based on the risk assessment of the loan. I know that's not perfect. FHA is a lot more explains this a lot more better. They define their reserve requirements, which there basically aren't any reserve requirements for 1 to 2 units. 3 to 4 units, there are 2 months of reserves. So with conventional, typically your automated underwriting results are going to tell you whether you need reserves. So they're going to look at your credit score, your debt to income ratio, your down payment, and then based off of all those risk factors, they're going to determine how much money, how much of a safety padding you should have before they're going to be comfortable with this. So ADU, an additional dwelling unit. So for 2 to 3 units, you can have a detached ADU. With 4 units, it's not permitted. And with Fannie Mae, it's not permitted. So if you have, let's say you have a duplex and then you have a detached, like a pool house or a little tiny home, like an 800 square foot tiny home with a kitchen, and it meets all of the living requirements. So it's like a rentable unit. With Freddie Mac conventional financing, you can have one ADU if there's a 2 to 3 unit property. If there's 4 units and an ADU, that's not permitted. If you're using a Fannie Mae conventional underwriting guidelines, you cannot have an ADU regardless of how many units. Well, you can have it with a single unit property, but you can't have it with a 2, 3, or 4 unit property. Now, this is the important one. So you can always get gifts to help you with the down payment and the closing costs, but using rents to qualify, that's a different thing. So these are the rents that are going to be the rent that you're collecting on the units that you're not living in. And you can use a percentage of those rents from non-occupied units as income for your debt to income ratio, and it's typically 75% of the rents. And those rents are calculated in a couple of different ways. So it's really important that you work with an experienced loan officer so that they can explain to you how that's going to work and whether or not you can use those rents. But there are different rules around that. So if there's somebody already living in the property and they already have a lease, you typically have to honor that lease. If it's a year-long lease, like an annual lease, if it's a month-to-month lease, you can always go in there, depending on the terms of the lease, you can give them a notice and you can get them out of there. But if there's a lease you used to have, you have to use those rents. And if there's not a lease, if those units are not occupied, then the appraiser is going to do a rental survey and they're going to determine what these units could rent for in this market. And then you can use 75% of that added to your income to help you qualify for the entire the debt to income ratio for the purchase of all the units. Again, it's so important that you're working with an expert when you're doing this. An experienced mortgage professional is going to reference the underwriting guidelines and they're going to research all of your options and present all of your options. That's one of the main reasons why I break these down between Fannie Mae, Freddie Mac, VA, and FHA. And I want to do that so that you know that there are different options depending on which loan program you go to. Many loan officers, especially loan officers that work in call centers. So if you think you're going to push a button and get a mortgage and you have something complex like units, there's a high likelihood that they're not going to know the underwriting guidelines because it's just not going to be easy enough. There's too many calculations, too much math. So that's the reason why we built findmywayhome.com. I started findmywayhome.com back in 2007, and that website is there specifically to help empower you, educate and empower you on these kinds of things that I've seen over the last 15 years. Call centers almost always screw up on this. They'll either tell you qualify when you don't, or they'll tell you don't qualify when you do. So we created findmywayhome.com to not only help you learn this information, but to connect you with a mortgage professional that we know, like, and trust, that's out there producing content like this to help educate and empower you to help you make more informed decisions. So there's two ways you can do this. When you go to our website, you will see you can scroll down to the bottom of the homepage and you can choose an expert by state. Or if you just go on the website, you'll see an expert who's licensed in the state near you. Or you can just fill out the form, let us know what your biggest question or concern is about qualifying for a mortgage, and we'll introduce you to somebody that can help. Also, while you're on the website, we're going to give you an opportunity to download our free financial fitness app. This is really cool. It's powered by a company called FinLocker. And this is an application where you can check your credit on a regular basis. Every month, it'll give you an update on your credit. You can create budgets. You can track your expenses, and it'll help create home ownership journeys if you're on the path to home ownership. It'll help whether you're 3, 6, 9, or 12 months out. It'll help you establish a budget, monitor your criteria, your qualifying criteria. And if your credit's not perfect, if it's not quite there, there's also really cool credit simulators that will show you what you can do to get your credit to where it needs to be. So I highly recommend that you take advantage of that. If you go to the website, you'll see that locker or that digital wallet advertised, or maybe it'll pop up on the top. But either way, it's 100% free. It's 100% private, and it will absolutely help you find your way home. So I hope this is helpful, and we will see you on the next time. Bye.